Hello everyone, and welcome to Investment Research. I'm Simo, your equity research analyst. If you see my video for first time, make sure to subscribe in order to listen to my daily report on stocks. And today I'm taking you through a careful analyst look at SoFi Technologies, ticker SOFI, as of October 27th, 2025. I will be transparent about the approach I use so you know how I reach conclusions. I follow the same components a professional equity research note follows: a concise top-line view, a look at the business and competitive context, a clear read on the most important financial and operating metrics, an investment thesis explaining why I would or would not own the stock, the concrete risks that could break the thesis, and finally a valuation frame and practical recommendation you can act on. I will speak plainly and in real investor language so you can decide whether this fits your portfolio and your risk tolerance. First, the market snapshot and price action. As of today, SoFi shares are trading around $29, showing that the stock has recovered strongly from its winter lows and is now trading close to its recent 52-week high from September. The intraday activity over the past week highlights higher volume and active participation from both retail and institutional players as the market prices in the upcoming corporate events and the company's recent operating momentum. This is not a sleepy name. It moves on data and on narrative, and right now the market is rewarding execution. Let's put the business in plain English. SoFi began as a student loan refinance platform and over the past several years has methodically expanded into a full financial services ecosystem. Today, it combines lending products including personal loans, home loans, and student loan refinancing with a suite of financial services that includes checking and savings brokerage and robo-advice, credit cards, and insurance. The company also operates a technology platform business through Galileo, which sells payments and account infrastructure to other fintechs and banks. The strategic pivot that matters is the national bank charter the company obtained, which allows SoFi to collect low-cost deposits, fund more loans in-house, and harvest larger net interest margins versus earlier peer fintechs that relied heavily on third-party funding. That vertical integration is central to how management argues it will sustainably monetize member growth and scale profitably. Now let us review the most important recent results because numbers are what separate a story from a fact. SoFi reported second quarter 2025 net revenue of roughly $855 million, and that result marked an acceleration in growth with revenue up about 43 to 44% year over year. The company delivered GAAP net income in the quarter and reported diluted earnings per share of about 8 cents. Those results were notable because they reflected both top-line expansion and continued improvement in operating margins, which management emphasized on the call as validation of their product mix and cross-sell strategy. The quarter also showed strong fee-based revenue, which points to the company diversifying away from pure net interest-dependent income. Those quarterly results are the basis for the more bullish re-rating we have seen in the stock this year. Beyond the single quarter, the operating metrics are equally important, and for SoFi they tell a consistent story. Membership additions are the leading indicator investors watch, and the company added roughly 850,000 new members in the second quarter, bringing total members to about 11.7 million. Product adoption is the other complementary metric, and SoFi reported more than 1,200,000 new products in the quarter, taking total products to roughly 17.1 million. Put differently, the number of products per member is rising, which is exactly what management wants, because higher engagement transfers to higher revenue per user and better long-term unit economics. Those adoption metrics are why the market is willing to pay for growth here rather than simply label SoFi a one-product fintech. Digging into segment economics gives us more color. Lending remains the largest revenue engine, with net interest income growing strongly, driven by higher loan balances and improving funding costs after SoFi expanded deposits. The financial services segment, which captures checking, savings, interchange cards, and broker activities, is now a large contributor with year-over-year growth well into double digits. Contribution margins in that segment have been expanding meaningfully, which explains why SoFi management has been bullish about the composition of future revenue. The technology platform continues to be a recurring revenue win, if only because it has less cyclical volume sensitivity than lending, and it gives SoFi an enterprise-style revenue line that investors understand and value. Across the company, adjusted EBITDA and contribution margin metrics improved, showing operating leverage is beginning to kick in as scale increases. Capital structure and liquidity are next, and they matter a lot for fintechs. SoFi carries a sizable deposit base, which provides lower cost funding compared to securitization or wholesale markets. That deposit cushion plus a multi-channel access to capital means the company has flexibility to grow originations without immediate pressure to dilute equity. At the same time, management has emphasized capital efficiency and prudent balance sheet management, which is why SoFi raised its full-year guidance after the strong first half. That guidance bump takes into account higher member growth and improved contribution margins, and it is the proximate cause of the year-to-date rally in the shares. Keep in mind that funding markets can change quickly, so the deposit advantage is a real moat only if SoFi continues to hold and grow deposits while not overpaying for them. Now, a frank view on valuation and expectations. The market currently prices SoFi as a high-growth fintech that has already delivered proof of concept for profitability. That combination typically commands a premium multiple, and we see that in consensus multiples, which are above banking peers. That premium is justified only if the company continues to execute meaningfully above the market's base case. Because SoFi has guided to mid-single-digit to double-digit growth in various segments depending on product, and has raised full-year adjusted net revenue guidance to roughly $3.375 billion. For 2025, the market is essentially betting on compounding product adoption and margin expansion into 2026. If management hits those targets, the multiple can be supported and the stock can re-rate toward the higher analyst targets. If they miss, the reaction will likely be swift. So what is my investment thesis in plain words? I believe SoFi is one of the clearest examples of a fintech that has transitioned to a diversified digital bank and is executing on the cross-sell playbook. The bank charter, deposit growth, and recurring revenues from Galileo create a diversified revenue base that materially reduces single product concentration risk. The company has demonstrated GAAP profitability on a multi-quarter basis, which makes the growth story credible rather than speculative. If you believe in digitally native financial services capturing share from legacy banks, and if you trust management to keep margins expanding while growing members rapidly, SoFi is a high-conviction growth pick. My bias is constructive for investors who can tolerate growth stock volatility and prefer a higher alpha fintech exposure rather than a bank ETF. However, I will be equally clear about the risks because they are not small. The first risk is valuation risk. The stock price already embeds robust execution, so any modest miss in revenue or EPS guidance can cause a sharp re-rating. The second risk is macro sensitivity. While deposits give SoFi a lower funding cost, the elasticity of loan demand to interest rates remains real, and a higher rate environment or sudden economic slowdown could pressure originations and increase credit losses. The third risk is competitive and regulatory. Large banks are investing heavily to keep customers, and there is increasing regulatory focus on fintechs that partner with banks or that operate at scale. Finally, execution risk. Scaling complex offerings across lending, payments, investing, and banking simultaneously requires flawless product work and operational controls. Any operational misstep or compliance issue could be costly to both P&L and reputation. What do I watch over the next 90 days, and what would move my thesis? The immediate catalyst window includes the upcoming Q3 earnings release and the commentary management provides on deposit trends, loan originations, and contribution margins. Concrete evidence that member growth remains north of expectations and that financial services revenue continues to scale would be the two biggest positives. On the downside, I will watch for signs of slowing deposit inflows, rising cost of deposits, or deterioration in net interest margin, and any guidance tone that turns conservative. Also monitor any material changes in capital allocation strategy, including large M&A or share issuance. For a practical recommendation and target, I would label SoFi a buy with disciplined sizing for most growth-oriented investors. The caveat is that this is not a buy and forget name. Position sizing matters. For a core growth sleeve, I would start with a modest allocation and plan to scale on confirmed signs of durable revenue acceleration or on significant pullbacks that correlate with macro or sentiment events rather than fundamental deterioration. If SoFi delivers continued strong execution, I estimate a reasonable 12-month target range in the low to mid-30s, which implies upside from current levels. If results disappoint, downside to the low 20s is plausible given the current forward multiples. My view is conditional bullish with explicit risk controls. Finally, a few tactical notes for investors. Use limit orders and avoid chasing after large moves. Watch implied volatility if you trade options because earnings and guidance cycles drive big swings. If you are long, hold through modest noise but consider trimming into strength if the stock rallies ahead of confirmed guidance raises. For conservative investors who still want fintech exposure, consider a blended approach where you hold SoFi as a satellite and pair it with more defensively valued financial holdings. That is my current view as of October 27th, 2025. I will be live after the upcoming quarterly release to dissect the numbers and tell you point blank whether management met the bar. If you want, I will publish a follow-up note that includes sensitivity analysis and a scenario-based valuation model showing bull base and bear cases. I'm Simo from Investment Research. If you found this useful, please like and subscribe and leave your questions below about valuation scenarios or about the specific metrics you want me to model after the next report.